real estate landscape in the United States has been significantly shaped by the decisions of the baby boomer generation, who hold a staggering worth of $18 trillion. Can they finally end the housing shortage with their exit?
If you are one of the many people trying to buy a home right now, you know how difficult the process can be. From soaring prices, cash offers, high interest rates, it can feel like a constant struggle, especially for millennials.
Boomers are the architects of a giant game of real estate, as they have played a significant role by influencing supply and demand dynamics in the US. But there's a big hidden player who does not want it to happen. The retirement of baby boomers has sparked controversy about the impact on the real estate market, with some hoping for a surge in available homes as the oldies exit the scene. Well, it's not that simple. The wealth that these baby boomers hold is not evenly distributed. The reality is that the homes of boomers are more likely to be passed down within the family or sold to institutional investors rather than hitting the open market. That's just how the market works. Even if it is to happen, there's a hidden player in the market which doesn't want it to happen. That hidden player, ladies and gentlemen, it's private equity firms, who are buying real estate linked to the elderly population in the promising aged care. This trend clashes with the assumption that a surplus of homes inherited by younger generations will flood the market. Investment firms are not just putting money into care for seniors and those with disabilities, they're also changing the housing market, making it tougher for millennials to buy homes. The number of people in the US who are 65 and older went up by 36% from 2009 to 2019, causing more investment in care for the elderly and disabled. In the past 5 years, major investment firms have been involved in 140 deals in this area. A study by Legal & General highlights that the competition for smaller homes is intensifying due to wealthy boomers, institutional buyers, and private equity firms all heading for the same housing inventory. Boomers currently own 44% of homes, while Gen X, aka the ones from the 60s, own an additional 31%. This dominance, coupled with the financial capability of these older generations, allows them to quickly acquire all of the affordable houses. The study reveals that only 43% of US millennials own homes, the lowest homeownership rate among generations, well below the overall average of 65%. Like said before, the problem of affordable housing for millennials is getting worse due to private equity firms and big investors buying up many smaller homes in the US. This, along with competition from, are they making it harder for millennials to find affordable housing? Question that arises out of this is, are baby boomers pushing millennials out of the housing market? As millennials face challenges in entering the housing market, private equity firms are not just reshaping the elder and disabled care industry, but are also reshaping the landscape of homeownership for the younger generation, which is causing the real shortage. That's not all. There's an even bigger preference problem, which is impacting the dynamics way more. You see, the issue lies in the mismatch between inherited properties and the preferences of first-time homebuyers. They may avoid areas concentrated with retiree homes due to a lack of essentials like job opportunities and quality schools. Think as a first-time homebuyer. Would you buy something in the middle of nowhere where ghosts make a party? Or in between average Joes like us? The answer is pretty clear. Relevant to current events, boomers, with their substantial $82 trillion wealth, initially contributed to the economy through spending. Now, a portion of this wealth is being used to take advantage of the struggling housing market. Despite an initial inclination to age in place and remodel during the early stages of the pandemic, recent research from the National Association of Realtors indicates that 39% of all homebuyers are now just boomers. But why exactly do they do this? What are the motivations driving baby boomers to sell their homes in the US post-retirement? The primary motivation for many boomers selling their homes during retirement is the need for financial resources. There is a painful rise in all of the commodities. Inflation slapping right across the face while the healthcare costs, including expenses related to nursing homes, continue to rise. A significant portion of retirees leverage the equity in their homes to fund their post-retirement years. Most of all, they don't have any option rather than just buying and selling since they are already retirees. This increase in healthcare costs, especially those associated with nursing homes and long-term care, has become an X factor influencing the real estate decisions of boomers. They have an insane advantage over the newer generation, though, something that the newer ones will never be able to overcome, at least with the current policy of the Federal Reserve. Here's where the plot thickens. These seasoned homebuyers, the boomers, are sidestepping the mortgage maze by mostly choosing all-cash purchases, effortlessly leapfrogging their mortgage-dependent counterparts. Among the 58 to 67 age bracket, about 32% chose for all-cash home deals in 2023, showcasing a daring increase from 22% in the previous year. Meanwhile, their older counterparts, aged 68 to 76, took it up a notch with 51% increase, up from 32%. The housing market gets even more interesting when we look through Redfin's lens. Wealthy Americans, especially the baby boomer generation, have a big advantage in the current market. They're like the leaders setting the tone for how things work. Redfin's senior economist, Shahryar Bakari, spills the beans. Affluent Americans are the only ones who can avoid the sting of high mortgage rates. These money maestros aren't just buying homes. They're smartly protecting their wealth by avoiding interest charges and keeping more money in their financial strongholds, which the newer generation could never, except if they are their successors. Now, let's dive into the numbers that underscore this generational prowess. Nearly 18% of the US population is now 65 or older, an all-time high since 1920. Thanks to good medical facility. Yet, the narrative takes a dynamic turn when you consider that boomers, constituting this silver-haired demographic, command about half of the entire US net worth. That's about $82 trillion. Real estate is their only investment, which beats out their pension funds and almost matches their stock market investments. In the financial chaos, boomers stand tall. They've got less debt and don't even bother with the student loan mess that younger folks are stuck in. This, my friends, is not just a housing market story. It's a veteran's strategic planning on the grand economic chessboard. The boomers aren't just aging. They're orchestrating a symphony of financial finesse that leaves the rest of us in awe. More than 80% of those over 65 own their homes, and most of them have finished paying off their mortgages. While on the other hand, the ones aged 35 to 44 have faced a decline in this same criteria of both mortgages. Now, this creates a difference between those who own the home and the ones who rent. Families, families, families. They add another twist to the story that make an integral impact. Another interesting factor affecting the housing market is the changing preference of families with children. More families with children are choosing to rent homes instead of owning them. In 2016, 14.3 million US households with kids were renting, a 16% increase in 10 years, while 22.1 million owned homes. That's a 14% decrease. This shift suggests challenges in affording home ownership. Over the same period, 3.6 million fewer families owned homes, impacted by factors like foreclosures, financial barriers for young families, and children growing up. This trend is seen nationwide and is particularly pronounced in major US cities. It's not just that. Younger generations are influenced by lifestyle choices and economic factors, often prioritizing experiences over home ownership. This shift, coupled with delayed marriage and family formation, has led to a lower demand for traditional single-family homes, impacting the types of properties available in the market. Not to mention the double-edged sword, low interest rates. Over the past 2 decades, the Federal Reserve has implemented various policies, including periods of low interest rates in response to rising inflation. These low rates have been both a boon and a challenge for young homebuyers, as they enhance affordability but also contribute to rising home prices, which creates yet another opportunity for all-cash buyers, the baby boomers. 2023 proved to be a challenging year for many prospective homebuyers, especially with a surge in mortgage rates reaching a high of 7.79% in October and median home prices exceeding $400,000. However, 2024 might offer a more favorable landscape for certain boomers. While home prices are expected to remain elevated, industry experts anticipate a softening in specific regions. The optimism is fueled, in part, by the Federal Reserve's decision to pause its rate hiking campaign in December 2023, providing potential relief for mortgage rates. Despite this, challenges to affordability are anticipated to persist in 2024 due to pent-up demand, low inventory, and lingering elevated mortgage rates until the Fed enacts cuts to the federal funds rate. Mark Fleming, chief economist at First Amendment Financial Corporation, envisions a flat stretch for the housing market in 2024, neither too hot nor too cold. Achieving a housing market recovery requires increased home inventories to ease price pressures and a gradual cooling of interest rates. While mortgage rates have recently started to decline, the Mortgage Bankers Association predicts a rise in total mortgage origination volume from $1.64 trillion in 2023 to $1.95 trillion in 2024 as rates drift down to around 6% by the year's end. Fannie Mae also anticipates a slow but meaningful recovery in single-family mortgage originations. Housing inventory remains a significant challenge, with low supply driving demand and sustaining high home prices. While some positive signs emerge, such as an uptick in home builder outlook and a slight increase in new single-family building permits, the overall housing stock remains near historic lows, particularly in the entry-level segment. Existing home sales experienced a slight rebound in November 2023, breaking a 5-month decline, hinting at a potential turnaround in 2024. Economists believe falling rates could attract both buyers and sellers to the market. Affordability concerns persist, with home prices soaring and the Fannie Mae Home Purchase Sentiment Index indicating consumer pessimism about the housing market. First-time buyers in particular face challenges as affordability conditions deteriorate. Despite price declines in certain areas, experts consider a housing market crash in 2024 unlikely. Homeowners today are in a more secure position compared to the aftermath of the 2008 financial crisis. Factors such as millennials entering their prime home buying years, wage growth, and financial wealth are expected to sustain housing demand in 2024. Foreclosure activity is projected to increase, but not to the levels seen before the pandemic. The strong economy, low unemployment, steady wage growth, and substantial homeowner equity are factors contributing to the resilience of the housing market. The decision to buy a home in 2024 still remains a personal one. While challenges persist, experts suggest that finding a suitable home that meets current and foreseeable needs, coupled with financial affordability, should be the primary consideration for both baby boomers and young buyers alike.